Hi, I'm Graham Bird. I'm the fund manager at Gresham House Strategic. Here just giving an update after an important milestone with us as fund managers. We've just gone through our 3-year anniversary on the 15th of August this year. It's been a pleasing 3 years, a very good start actually to the strategy. The net asset value has performed strongly in that period, up 27.3% since we took on the mandate, and that compares to the small cap index, which in the same period was up 16.1%, and the all share up 15.9%. So a good outperformance against those key benchmarks. On a total return basis, the net asset value was up 30.9%, and that compares to the small cap index up 26.8%. So again, a nice outperformance during that period. Share price, of course, important for shareholders, up 35% in that period. So again, very pleasing performance, and we'd like to see that continue. I think importantly, the last year has been a very strong performance after the first 2 years, which were a little bit more lackluster, partly from some cash drag during that period. But good to see the effect really, I suppose, of coming through the other side of the J-curve. A lot of what we do invest in does take time to come right and investments to start to perform. And the performance of the net asset value has been driven by some of our more mature investments. So really pleasing to see that coming through. What's also been pleasing is that a lot of that performance has been driven by realizations and not just unrealized gains. During the period of 3 years, we've sold just over £24 million worth of shares, realizing a 1.6 times money multiple and an internal rate of return on those disposals of just over 28%. So again, well in excess of our target of 15% per annum on each investment over the life of the investment. Proving really that the strategy does work, and holding it through that investment cycle is important to generate those returns. I think some other key milestones, total investment in the 3 years is just over 28 million. We've invested in a total of about just on 20 companies during that period. We now have 15 in the portfolio, which was exactly what we had set out to do, core holdings of 12 to 15 companies comprising the majority of the net asset value. So very much true to what we set out to do. And I think importantly for shareholders too is there's been some strong returns through dividends. The board has been very minded to ensure that those shareholders are looked after. We paid our maiden dividend back in 2017 of 15p per share. And this year that was increased 15% to 17.25p. So we'd like to see that progressive dividend policy going forward, and I'm confident that we will. At the same time, we've also returned just over £1 million, £1.2 million in share buybacks, modest buyback last year of 200,000, and that was supplemented by a significant buyback in May this year where £1 million was spent on buying back shares, which led to an enhancement in the net asset value as we were able to buy those shares at a discount to net asset value. So all of that I think bodes well as we take it forward, and I'd like to see those returns continuing. So having had 3 years of implementing our strategy, I guess one of the questions is what have we learnt and have we changed the way in which we're doing things? I think the honest answer is no, we haven't really changed what we do. We really are implementing a strategy which we've been doing, certainly Tony Dalwood and myself, for nearly 20 years now. So we haven't seen a great need to change that, but of course one does learn and observe what's happening all the time, and the markets do change. So yes, we have learned some things, and I think there are some key messages to come out. The first is this is a long-term strategy, and things do take time. We often invest in companies which are going through substantial change. We talk about identifying catalysts which will create value, or certainly create the realization of value as those changes take place. And both within the operations of the company and also in the relationships which we form with the management teams, those changes do take time, and one needs to be patient and to let them happen. And quite often things get worse before they get better, but ultimately this is about a longer term strategy, and one plays for the big picture changes in the businesses, and when those do come through, that's when you see the real value creation. I think another point that we've really learnt and has been re-emphasized in the last 3 years is that the relationships and the proactive management, proactive engagement, with the companies is very important. And that can generate not just opportunities for investment, but also it helps make those changes and gives the companies confidence that what they're doing is the right thing. So a good example of an investment which was really generated through those relationships is our recent investment into Northbridge, where we invested in a convertible loan note. And really through our relationship, we're able to identify the need that the company had to refinance its banking facilities as those were coming to an end. And that provided us that opportunity to present something to them and propose what has turned out to be a very interesting investment opportunity for our fund. And that's led to refinancing and a good outcome for the company as well. So certainly that's another lesson. Those relationships are very important. I think the other point that I would sort of point to is that being a contrarian investor, which to an extent we are, we look at value investments, we're looking for companies which we believe to be intrinsically undervalued. Being a contrarian investor needs self-confidence and again, you need to hold your nerve on occasions, because essentially we're looking for things in companies which the market, we believe the market doesn't see. And as you will have seen in some of our previous presentations, we've talked about the long-term performance of value investing against growth. And over the last 10 years, we've had a protracted period where value has underperformed growth. And we believe that will change. But for the moment, we're continuing to see momentum strategies doing very well. But I think now is a very interesting time for value. Stock markets are towards the higher end of their valuation ranges, and value is coming back. So being that contrarian investor, requires that belief and continuation of what we're doing. So I think that all sort of bodes very well. So I don't think that means we need to change what we're doing. I think we are getting smarter at what we do and more disciplined in how we do it. And all of those things put together should mean very good returns continue from here. So I guess the final question really is, what do we think of the portfolio and what do we think is going to happen from here on in? Candidly, I do have some concerns about the coming months. I think we have certainly seen some evidence of slowdown in certain sectors in the UK economy. Causes of that, certainly the rhetoric is that people are nervous about or cautious about what sort of Brexit outcome we might have. And that's fed itself through into certain sectors, an example being the media sector, where we've just seen a slowdown in the pace at which people are spending money, and I think people just taking longer to make decisions. So that's impacted investments such as Herd, which have just seen a gradual softening in their markets. Having said that, I think from a global perspective, we still see the global economy in reasonably good shape. And the UK with a weaker currency that it's had, should be reasonably well placed over the longer term to benefit from that. So I feel quite comfortable sitting on a reasonable amount of cash at the moment, which we've generated from reducing our stake in IMI, and I think that gives us great opportunity to take advantage of some weakness which we may see in the coming months. So I guess that is certainly our focus, is to build that pipeline and be ready to take advantage of those opportunities as they arise. Within the existing portfolio, I'm pretty confident with where it sits. If you look at the valuation across the portfolio, on a blended basis, we have a portfolio which is rated on just on 8 times EBITDA, and that compares to a market, the All Share, which is on 9.5. And so we are certainly more attractively valued than the market as a whole. I think the other point to draw out is that the forecast turnover growth within our portfolio is 13.5%, and that compares to the All Share growth of about 3.5%. So our companies are growing faster, and certainly when you take that down to an EBITDA level, we're anticipating around 20% growth across the portfolio in EBITDA. So we're getting good growth at an attractive valuation. if you take into account that you can buy the Gresham House Strategic shares at an 18% discount to net asset value, you're effectively buying the portfolio on 6.7 times EBITDA, and that falls to 5.3 on 2019 forecast. So again, I think from an investment proposition perspective, we're in a good place and offering investors a great opportunity to buy an attractively valued portfolio. So overall, yeah, I think hopefully we can repeat and improve on the performance that we've had in the last 3 years in the next 3 years, and that's certainly what we are setting out to do.